We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us today. You can always learn more about Brian and the team by going to the website, deckerretirementplanning.com. I always say this to start the show because it's a really neat opportunity for you if you want to gain some insight, some information into retirement, the financial world. On the Decker Retirement Planning website, deckerretirementplanning.com, under the heading of Safer Retirement Education, there's 12 different things you can download, including Brian's book on retirement, The Decker Approach. So it's a great opportunity for you just to kind of gain. There's no obligation, no charge, nothing. All that information is there for you to just check out different areas. So just go to Safer Retirement Education on the Decker Retirement Planning website and then download whatever you want. It's a great opportunity for you just to maybe get some questions answered. Kind of a neat opportunity for you. You can always call Brian and the team, 833-707-3030. If you have questions, you have concerns, 833-707-3030. I'm Mark Elliott. Glad you're with us today. We're going to talk about today why traditional strategies fall short in flat or down markets, and then how Decker Retirement Planning's two-sided approach can help. We've got a lot to cover today. I guess your advisor's strategy, does it work when markets are flat or falling? That's kind of that's where we're going to kick this show off today, right?
Right. So, Mark, there's been 4 times that the S&P 500 has traded above a market valuation of 30 times trailing earnings. That's only happened 4 times. One was 1929, and it took 17 years to get your money back. The second time was 1964, 18 years to get your money back. The third time, November of 1999, 14 years to get your money back. Well, the fourth time was November of 2021. We hit 32 times trailing earnings. And if history repeats, and by the way, 100% accuracy with history repeating, we're looking at least 10 to 15 years of markets being flat, meaning they'll go 2 steps forward, 2 steps back, and then 10 to 15 years from now, they will be no gain from November of 2021. Now, if you're in your 20s, 30s, 40s, 50s, no big deal, because your income is coming from work and your 401k, you're contributing to it every 2 weeks. But if you're in retirement, to have a zero return over 10 to 15 years, that's devastating because the income that you're generating from your nest egg that you've saved up 40 years for has a no gain, and you're drawing down on that over a 10 to 15 year period. Many people will have to go back to work. So I hope they listen very, very carefully.
Now, 2024 has been a good year for the markets, hasn't it?
That's true. And from 1964 to 1967, there was a 3-year period where the markets went up, but then the markets gave it all back. What we're talking about is when markets trade at this high of a valuation, future 10 to 15 years are flat. And so look at what Warren Buffett's done, Mark. He's raised records amounts of cash. Look at his favorite market valuation, price to GDP, the highest since November of 1999. So we're looking at market valuations where price to GDP, price to sales, trailing. Why do we use trailing price earnings? Because
I don't even know what a trailing price thing is. What are you talking about?
Trailing price earnings ratios. It's the price of the S&P by trailing 12 months earnings. And so that gives an actual number where future estimates of the price earnings ratio is not actual and is 90+% of the times inflated. So we use actual numbers for that market valuation. So let me give you an example. When we talk about market valuation, these are different data points that allow us to see if a market is expensive or not. Mark, let's say that you've got a neighborhood with 25 homes And I'm going to be oversimplistic here. All the homes are selling for $1 million. And you put your home up for 1.5, and it's no different from all the others. Is your house expensive or not?
Expensive.
Okay, and if your home is priced at 800,000, it just allows a metric to see if your home is expensive or not. And so what we do is use the same data points across 100 years of history to give us a very good idea. And we're hoping for the best, but we're planning for the worst. What we want to point out here on the radio show is there's options, because if you have a passive investment strategy with your advisor, buying and holding stocks, mutual funds, indexes, or ETFs, and you buy and hold them, meaning passive, they're not actively traded, you're looking at a zero return over the next 10 to 15 years. And as I said, if you're in your working years, no big deal. But if you're retired or within a few years of retirement, that is devastating. So what are your options? Well, instead of buy and hold, what if you use a dividend strategy? I'm going to skip down, Mark, and just cover some options, but I'm going to jump back into the strategy that we do recommend, which is momentum. We're going to spend time on that. But a dividend strategy is something where, and it's easily the most popular investment strategy in retirement. This is where, and it's almost like a religion. They all say the same thing when they come into the office, quote unquote, Brian, I don't care what the markets do. I just let the dividends roll right in. So the people that do that, there are a couple of problems that we see with the dividend strategy that we just want to highlight for radio listeners. Number one, it's called yield creep. So Mark, humans, if the 10-year treasury is at 4.5 right now, and you have a dividend of 5.5, 5.5 is better than 4.5, right?
Yes. And
your golfing buddy, Frank, he's got dividends. He's got a dividend portfolio with some in there yielding 7. 7's better than 5.5, right?
Correct.
Okay, so very, very smart people have this affinity to creep the yield up to where, without their knowing it, over 18 months, most all of their dividends are now 6, 7, 8 plus %, and they're taking high risk without knowing it. And we want to expose that risk in 2 different ways. Number one, we look at coverage. How much does XYZ company cover their dividend? So here's where we go to EBITDA. We check out the dividend. Let's say it's $1 a share. And let's say that EBITDA, earnings before dividends, interest, taxes, and amortization, let's say that it's 60 cents. Their EBITDA is not covering the dividend. That means they're borrowing 40 cents to pay the dividend. How long are they going to do that? Probably not very long. Is that high risk? Yes, it's high risk. Any company that's not covering their dividend by at least 150%, in our opinion, is taking unnecessary risk with your retirement funds that you can't replace. And so we want to make sure that that would be check number one, is to see what kind of coverage the company has on their dividend. Point number 2 on the dividend strategy is the concentration risk. Most higher dividends at least, are coming from 2 sectors of the market, energy and real estate. Does energy cycle? Yes. Let's go back to 2020 when, for the first time in my career, I've never seen this before, for the first time in my career, I saw the inversion where the futures on crude oil went negative. In August of that year, the August futures for crude oil went negative. Most of the energy stocks got creamed in 2020, and a lot of the dividend yields that came from energies, they ended up cutting their dividend. Now, when you have a dividend yield portfolio and you have a dividend cut, here's how it works. After hours, they announce a dividend cut. It opens the next day without the dividend. Stock drops 20, 30%. You take the loss. You have to replace it because in a dividend portfolio, you need your stocks to pay a dividend. and you book that loss. So in 2020, most all the energy stocks took major hits. What about real estate? Does real estate cycle? Yes. In 2008, that's when a lot of the real estate cycle hit down hard. The average REIT that year was down 70%, and most all the dividends payable on real estate were either cut. Well, most of those dividends were cut. So do dividends have concentration risk? Yes, they do. And again, what we're looking for is a consistency of performance in the risk portion of your portfolio. And we want to make sure that in a worst case scenario, like a flat market cycle, like we believe that we've entered, that you're able to make consistent money during a flat market cycle. So what strategy could do that? That would be momentum. So there's a few reasons that we at Decker Retirement Planning use momentum strategies for our clients. Number one, we are fiduciaries to our clients, and we're math-based, and we've done the research. And in a book called What Works on Wall Street, Jake O'Shaughnessy's book, page 367, Appendix A, you can see the biggest study ever done since 1950 on the best performing risk strategies. The top 15 are all momentum, relative strength, and sector rotation. These all mean the same thing. Every stock is ranked based on relative strength, which is a function of price appreciation and volume. And momentum has you buying the top relative strength stocks until something comes along that's better, and you rotate into what's better. It is sector rotation, it is relative strength, and it's pure momentum. So for example, let's go through a market cycle. In 2000, 01, and 02, the S&P was down 50%, NASDAQ was down 70%, but during that 3-year period, momentum had you buying what was going up. And that was many sectors. That was real estate through the REITs. That's gold, silver, energy, pharmaceuticals, biotech, healthcare. Those were making double-digit returns each year. You wouldn't have even known that the markets had damaged so many people if you own that kind of a portfolio. Then the markets bottomed in March of 2003, and what exploded to the upside for the next 4.5 years was semiconductors, technology, emerging markets, small caps. They made tons of money. And then rolling into 2008, momentum is absolute return focus, meaning if there's nothing going up, you're stopped into cash. And so you had a cash-heavy portfolio in 2008 with the exception of Treasury bonds. Treasury bonds were up 22% in 2008. So that's how momentum works. Most recently in 2022, S&P was down 19%, bonds down 20%, NASDAQ was down 33%, commodities across the board were down. 2022 was a very difficult market. Russia had invaded Ukraine. Energy was the only sector doing well. So momentum had you in pipelines, had you in natural gas companies, crude oil companies, the frackers, the drillers. Those made 15 to 20%, while that year most people lost 30%. So momentum is what we recommend for clients. It's a way to cherry pick the markets when the markets are going up, taking the best parts of the market, and also when the markets are going down, able to find and locate anything that is going up and investing in those.
So if you'd like to sit down and talk with the team at Decker Retirement, all you have to do is give them a call, 833-707-3030, 833-707-3030. There's no cost for this chat. There's no pressure. There's no obligation, no judgment as well. But at the end of the day, if you'd like, well, how does this momentum stuff, how would it work for me and my portfolio, for my family? Well, it's a great question because Brian and the team don't know until you have a conversation with them. 833-707-3030 again is the number. Might be the most important phone call you make. At least, if nothing else, you're going to get clarity into your retirement picture. 833-707-3030. We're going to come back. We're going to talk about the two-sided solution, why all of this really matters for retirees. That's where we're going today on Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. We're back right after this.
Legacy planning is more than just numbers. It's about the impact you leave on generations to come. Let Brian Decker guide you in creating a lasting legacy. Call Brian and the team at 833-707-3030 3030 to start your legacy journey.
Uncle Sam might need a loan soon. From you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. You can always learn more on the website, DeckerRetirementPlanning.com. You can always give them a call, 833-707-3030. Find out where you are on that road to retirement. Do we have enough? Are we going to be okay? Will our money last? Big questions. 833-707-3030. I'm Mark Elliott. We're talking about traditional strategies versus the strategies of Decker Retirement. So you think of the old strategies, kind of that buy and hold, right? Put your money into the 401k and just let it go and hope for the best. That is not the way to do it really when you get into retirement and get close to retirement. Now it's about being a little bit more pointed, a little bit more directed, having a little bit more control. We never really control the markets, but you're controlling where your money is as far as risk and safety. So that's kind of a big deal here. You were talking about the two-sided solutions that you always come up with for your clients, where this does poorly, well, you get out of it. This is doing well, we get into it. But it's hard to really time the market. So I guess you were talking about the two-sided momentum strategies. How do you kind of maintain that? Because you can't time the market. You're not going to make it perfect at you're not going to get out at the highest and get in at the lowest all the time. How does this all come together?
Yeah. There's a difference between predicting the market and reacting to the market. Now, there's some very good people that do quantitative analysis, and they will make predictions on where they think the markets go. That's not what momentum is. Momentum reacts to what is going up, where the market is going, where money is going, where volume is going. And it follows that. It's like riding a wave until the wave peters out and you catch another wave. Whatever wave is rolling the biggest is the wave that you're on for as long as that wave takes you. For example, there's a time to be in technology. If you haven't been in technology since October of 2022, you have left a lot of money on the table, technology and semiconductors. However, if you own technology and semiconductors from January 1 of 2022 to October of 2022, you took a beating. You took a major beating, 30+%. So there's a time to own technology and a time to not own technology. There's a time to own gold and a time not to own gold. There's a time to be in real estate and a time not to be in real estate. So sector rotation, also called momentum, is where an algorithm takes you to where your money is treated best, where you've got the wind at your back. That's how it works. Now, we've taken another step. And by the way, for this segment, just to bring on new listeners, there's a study done that there's been 4 times where the S&P 500 is traded above a market valuation of 30 times trailing earnings. One was 1929, and markets were flat, up and down for 17 years. 1964, markets were flat for 18 years. November of 99, markets hit that valuation. Markets were flat for 14 years. Well, we hit it again in November of 2021. We hit 32 times trailing earnings. So that means with 100% history backing it, that the expectation is for the next 10 to 15 years to be very flat. That means buying and holding stocks, mutual funds, indexes, and ETFs will yield a zero return over the next 10 to 15 years, which is devastating for people in retirement. Not so much for people at work because their income's coming from work. But we talked in the first segment. If you missed it, it's worth going back and looking that up under the podcast, Safer Retirement Radio. But in the second segment, we want to go into more detail. Momentum has you investing in whatever is going higher. Now, there's a Vanguard statistic that says that 85% of money managers and mutual funds underperform the S&P every year. Well, momentum hand cherry picks what is going up the most. And so it takes the best parts of the index, takes the best parts of the market. Since January 1 of 2007, when the 5 managers started that we're using, S&P's averaged about 9.2%. The managers have averaged twice that at 18. And so that's the way that they're able to do that is because they don't have to own the entire index, the laggards included. They just take the best parts. So we use that for our clients at Decker Retirement Planning strategically so that we are able to produce a more consistent return. When the S&P is in an uptrend, trading above its 200-day moving average, we have, just like in the NFL, we have the offensive team on the field. When the market is, we have 5 different strategies that are hand-picked momentum strategies that have done very well in uptrending markets. Now, when the market crosses the 200-day moving average and starts in a downtrend, that's when we go and we pull the offensive team off the field and we put the defensive team on the field for momentum strategies that have made money in every down market since 2007. They made money in 2008. That's a big feat. They made money in 2015, 2018, and 2022. So this is the way we've done our research. This is the way that we can help our clients do the very best on their risk accounts. Now, we help lower our risk for clients in a couple of different ways. One is strategically. We just talked, Mark, about how we help retirees use momentum strategies, which maximizes returns on the upside and allows us with a two-sided strategy to even make money in a down market. Who does that? And so we've done the homework and found that that is the way that strategically we can maximize the returns in an up market and even be able to make money in down markets. So if we have a flat market cycle, like we think we will over the next 10 to 15 years, our clients will be able to do well instead of having a zero over the next 10 to 15 years. Second, we lower our clients' risk strategically and also quantitatively. Quantitatively, most clients that come to us come from bankers and brokers who are paid to keep your money at risk. They are not paid unless your assets are at risk. And so we have many clients coming in retirement that have 60, 70 plus % of their retirement nest egg at risk, which we think that's insane. We've lowered our client risk to about 25%. That is enough money to grow over 20 years and replace the 75% that they spend from principal guaranteed accounts in buckets 1, 2, 3, 4, and 5. Those are laddered principal guaranteed accounts. So, Mark, I want to talk about 3 ways that in a flat market cycle that we can help clients do well. So we talked how the risk strategy of using momentum strategies can do well and be able to make money in up or down markets. There's a second part of client portfolios, and that is principal guaranteed fixed rate accounts. So this would be high yield money market accounts. We use the Fidelity Money Market, which right now is about 4.5%. And we also use 3 and 5 year CD rates. So bucket 1 is a money market account. Bucket 2 is a 3-year fixed rate CD. Bucket 3 is a 5-year fixed rate CD. Those first 3 buckets then in 2022, for example, a horrible down market where the S&P was down 19, NAS down 33, bonds down 20. Most people got shellacked in 2022, and our clients on their whole portfolio, they made money. We were one of the few firms in 2022 that made money. It's a great litmus test. You should ask any of your advisors before you hire them if they made money in 2022. We did. Because buckets 1, 2, and 3 were fixed rate accounts. They make money no matter what. CDs make money no matter what. Money markets pay out no matter what. 4 and 5 are 7 and 10-year principal guaranteed accounts with variable rates that have averaged about 2 times the CD rates, between 8 to 10%. These indexes allocate daily between stocks, bonds, and commodities. And so you could have a horrible year in the stock market like 2008, where stocks and commodities did horrible, but bonds did well and do well. You can have horrible years like 2000, 01, and 02, where the S&P is down 50%. Commodities were up and bonds were up. And so they were able to make money because they have 3 different markets to allocate to. That produces a higher return. It's principal guaranteed. And there's a consistency of return because they're looking at 3 different markets to invest in. So when you put that all together for a portfolio, going in a flat market cycle, we're hoping for the best, but we're planning for the worst. That allows us in up markets to do well and take advantage of up markets. But in a down markets, bucket 1, 2, and 3 are going to make money no matter what. And buckets 4 and 5 have 3 different markets to invest in. And the risk bucket has an offense and defensive strategy. So we are prepared at Decker Retirement Planning for an up market or a down market and produce a consistency of return for our clients.
If you'd like to learn more, what does this mean to me and my portfolio, or our portfolio? How does this all equate to us maybe having a better retirement than maybe we'd even hope for? Don't know. Not until you reach out and talk with the team at Decker Retirement Planning. It's 833-707-3030. Again, there's no cost for this whatsoever. There's no pressure. There's no obligation. 833-707-3030. Two-sided strategies versus the old buy and hold. It's much different. But again, you don't have 100% of your money at risk either. There's a safe portion of your portfolio that Brian and the team set up because you're retired. You're not working anymore. You're not getting paychecks. You've got to maintain some of that protection and safety to your portfolio. If you'd like to learn more, again, it's 833-707-3030. Back with more with Brian J. Decker of Decker Retirement Planning right after this.
Do you need help assessing your risk tolerance or adjusting your portfolio to help reduce your fees? For help with income planning, set up an appointment with Brian Decker today. Call 833-707-3030. That's 833-707-3030.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Again, the website, deckerretirementplanning.com. Find out more about Brian and the team, where the offices are. All of that information is there. There's some great information on the website, deckerretirementplanning.com. And there's also on the heading, when you go to the website, there's a heading of different topics. There's one, Safer Retirement Education. There's 12 different things you could download, including Brian's book on retirement, the Decker Approach book. But there's a lot of information there for you, and there's no cost to go download whatever you want. It's there for your information. Again, that's on the website, deckerretirementplanning.com. If you'd like to give the team a call, you got questions, 833-707-3030. No cost to chat with the team. They're here to help if they can. They don't know if they can help you until you reach out. But you certainly get your questions answered, maybe your concerns talked about, and kind of get a feel for where you are. 833-707-3030. I'm Mark Elliott. Glad you're with us today. You know, one of the questions we posed early, and you're going to touch on it right now, Brian, is the fact that, you know, when we do invest, one of the challenges really is, are we doing the right things? Most of us, I don't know about most of us. I know I'm in the category of I don't really understand all this, so I just put the money in the 401k and hope for the best. Brian's telling me I'm not doing it the right way, so I'm going to have to adjust. That's just how that works. But when you think about it, the advisor strategy that you're using, or that your advisor is using for your portfolio, how does it do when the markets are flat or falling, which you've been talking about, Brian? Talk about that. Does your advisor strategy work when markets are flat or falling?
Well, when you're in your 20s, 30s, 40s, 50s, if the market's going up, down, or flat, no big deal because you're accumulating assets. Your income is coming from your work And every 2 weeks, you're kicking new money into your 401k. So if the markets are down, every 2 weeks, you're buying into a down market, and you have the time, the 3 to 5 years for the markets to recover, and you're better off for it. And you can handle a flat market because while you're working in your 20s, 30s, 40s, 50s, you have the time to outlast that flat market. Now, some of these flat markets, most of them are 17, 18 years. Do you have that kind of a time to ride it out if you are retired? Now, if you're retired, a down market or a flat market, let's say the markets drop 30, 40, 50%. When you're working, no big deal. We already talked about that. But when you're retired and drawing money from that portfolio that's down 30, 40, 50%, that is terminal. That is a killer because you're drawing money from a fluctuating account. When you draw money from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down. And when you're pulling money from a down market, that is rough. We don't do that at Decker Retirement Planning. We have our income coming from laddered principal guaranteed accounts. But let's go back to the typical banker broker model. There's 3 options in the markets. Up markets, you will do very well with an accumulation strategy. When you're retired and it's a flat market over a 10 to 15 year period, like we expect, that is a killer for someone in retirement. Your money hasn't grown over 10 to 15 years. The banker broker accumulation pie chart model does not work in that scenario. The third option, a down market over 10 to 15 years. If the markets are down, that is a killer in retirement. That means you're drawing income over a long period of not only something that hasn't made money, but something that's gone down. Let's replay the 4% rule because this is the banker broker distribution model. So Mark, the 4% rule goes like this. William Bengen came up with this strategy. He noticed that over the last 70 plus years, markets have averaged about 8.5%, 9%. Bonds have averaged around 4%. So 4.5% or so. So let's just draw 4% from your portfolio and that should be fine. Well, that works in an up market. Does it work in a flat market? Mark, you're the beneficiary, you won the lotto, and you get $5 million January 1 of 2000. That's the good news. The bad news is markets are down, and you have a 60-40 portfolio. So markets are down 50% in 2000, 01, and 02, and you draw 4, 4, and 4. So you're not down 50% on that 60%, your risk portfolio. You're down 50 plus 4, 4, and 4. You're down 62%. And then the markets come back to where they're even in October of 07, but you don't get all that because for that 5-year period, you're drawing 4, 4, and 4. You're drawing 20% in a market that was down and is climbing. And then from October of 07 to March of 09, that was a 50% drop, and you took the bigger hit, and people didn't need a slide rule or a calculator. You could see that you were devastated in your retirement, and millions of people were hammered by the 4% rule. William Bengen, even the creator of that strategy, William Bengen, he came out in 2009 and says that it doesn't work in a down market. Now, you would think that we're in a flat market. You would think that bankers and brokers would have changed the strategy, but they don't. They still use the 4% strategy. 4% rule strategy to distribute assets and for people that are in retirement. We want to warn you against it. In a flat market, it will destroy your portfolio. In a down market, it will destroy. There's 3 options here and 2 are bad. In 1940, the 10-year treasury was at 2%. In 1980, the 10-year treasury was almost 15%. During that 40 years of rising interest rates, if you own bond funds, you lost a ton of money. Now, from 1980 to 2020, that 40-year period, you made a lot of money because interest rates went on the 10-year treasury from almost 15% down to 0.47 in August of 2020. You wanted to own bond funds. But in a rising interest rate environment, you do not want to own bond funds. Rising interest rates means you lose money in bond funds. So, for example, in the last 4 years, most people have been told by their bankers and brokers that their safe money needs to be in bond funds. Well, their safe money in the last 4 years have lost over 30%. We want to warn you to stay away. In our opinion, there's no reason in a retirement plan to own bond funds. We want to warn you of interest rate risk.
So, yeah, at the end of the day, I mean, if we're going to be a passing football team, but there's 6 minutes left in the game, we're up 2 scores, we're not going to be throwing it. We're going to be running the clock out is what we're going to do.
Right. And using that analogy, a good retirement plan preserves what you've got. There's a great quote that's saying you've got to have risk to beat inflation, but to be a successful investor, you've got to manage risk and avoid big losses. So that's what we try to do. And looking at a banker broker model, they use something called the Monte Carlo strategy. How would you feel, Mark, if you had a 94% chance of succeeding in retirement? Would that rattle you a little bit, or would you be able to sleep at night?
I feel pretty good about 94%.
Okay. Well, guess what? 2008, 2022, seems like every 7 or 8 years you get nailed in retirement with one of those market drops that fall into the 6% group. So it's very disconcerting. The number one fear of people in the United States over 60 is running out of money before you die, because they're looking at a pie chart and told that a pie chart is their retirement plan. A pie chart is not a retirement plan. A pie chart is a portfolio allocation detail telling you how you're invested in your retirement portfolio. It doesn't help you know how much you can draw each year for the rest of your life, but that's what a distribution plan does. A distribution plan is a plan. A pie chart is not a plan. So number one fear in people in retirement is running out of money before they die. People that are our clients see how much money they can draw each year for the rest of their life. And the second big fear of people in retirement are these market drops that swing through every 7 or 8 years. Now, if we have a flat market cycle that we've started, that we've talked about in segment 1 and 2, buying and holding passive investment strategies are not going to work. Buying and holding stocks, mutual funds, indexes, and ETFs will yield a zero return if history repeats. History that's been 100% accurate the 3 other times that the S&P have traded above a market valuation of 30 times trailing earnings, which happened again in October of 2021. So we want to make sure that clients have a high probability of success. One key is have a plan. Number 2 is to minimize risk quantitatively and strategically. 3 is tax reduction. Make sure that your portfolio allows tax planning. Number 4 is portfolio optimization, where each part of your portfolio is optimized. Number 5 is income optimization. Make sure that you're maximizing your net of tax income. And 6 is fee minimization.
So you think about that. Brian asked me earlier, would you be okay with 94% chance of success in retirement? Well, yeah, because right now it's 50-50. That's why I'm working. 65 years old, I can't retire. So if I had a 94% chance, that would be good. But most of us wouldn't like that. Hey, you're getting on the plane to fly from Salt Lake City, you're going to Los Angeles. There's a 94% chance you should make it. Odds are in your favor, but would you take that chance? That's where this portfolio management that Brian and the team at Decker Retirement can do for you is where you certainly need some growth, because things will cost more during your retirement. There's no question about that. But you don't need all of your money sitting at risk. Got to have some of it safe and protected. And that's where everybody's situation is unique. And that's how Brian and the team look at it. What is your situation? Is your portfolio set up the right way? Do you have too much risk? Maybe you have not enough risk. Maybe you're lucky and you have the right amount of risk. That's one of the things you can find out by just having a conversation with Brian and the team at Decker Retirement. It's 833-707-3030. 833-707-3030. And whenever you have a change at the White House, then there's different sectors that do well in the markets. So it's really about putting your portfolio in the right place for what's ahead. We don't know. We don't have a magic crystal ball, magic 8 ball or the crystal ball, but it's really about the research and the math-based team that Brian has set up at Decker Retirement. It's about you. How can they help? They don't know until you reach out. 833-707-3030. Again, this is totally free. There's no cost to you. 833-707-3030. Might be the most important phone call you make. 833-707-3030. Back with our final segment of Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning right after this.
Maximizing your deductions is like finding hidden treasures in the tax code. Let's navigate the financial landscape together. Call Brian Decker at 833-707-3030 for guidance.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. Again, you can go to the website, DeckerRetirementPlanning.com. A lot of great information there. You can also go to the heading on that website of Safer Retirement Education. Download Brian's book on retirement if you want to, The Decker Approach. 3 Principles of Retirement book, the Checklist Challenge, Sample Income Plan. Those are just 4 of the 12 things you can download on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. No cost to you. It's all there for your information. You want to learn more? Just go there and check it out. Take what you want. Download whatever you want. We're talking today really about where the markets are, where they're headed, but it's really about you and your portfolio. We don't want to run out of money before we run out of life. So the idea is, how do we set up our portfolio? We're taking too much risk, not enough risk. Do we have enough guaranteed income to not worry about what happens with the markets, certainly during a flat time in the markets or even a downtime in the markets? So the question really that I'm going to pose to you for this final segment is, so you think about a lot of people like me. I don't really understand the financial world. I knew back in 2009 I should have spent that $1 to get me 100 Bitcoins, but I did not. And if I would have, I could be retired. What, 90,000, 95,000 a coin now or some crazy thing like that? And it was less than a penny for a coin back when they started. Nobody knew what it was. We still don't know for sure what it is. But you think about that buy and hold strategy. I'm putting my money into my 401k, just every paycheck, money goes in. I don't really know what it's doing because I don't understand it. That's where Brian and the team at Decker Retirement come in to help guide you. Once you get to 59.5, you can roll your 401k while you're still working. You keep contributing, taking advantage of the company match, but now you've got your portfolio a little bit more organized for you. And Brian and the team can certainly help you with that. But the question is, how do I transition from the buy and hold strategies of old, and how do I move that into this two-sided approach that you're talking about? How do we make that conversion?
Okay, there's pieces of your portfolio for tax strategies that allow us to move different pieces to the right spot. So for example, your Roth money is growing tax-free. It distributes income back to you tax-free, and it passes to your beneficiaries tax-free. The spot for Roth money for us is the growth portfolio, the risk bucket. We are doing clients no favors by taking an IRA from $500,000 to $5 million. Now they have an account that they owe $5 million in tax on when they could have paid tax on $500,000. What we want to do is over 5 to 7 years, we want to convert IRA to Roth in the risk bucket, not in buckets 1, 2, 3, 4, or 5. Those are principal guaranteed accounts. You're taking income too soon. It is only in the risk bucket that we want to see Roth money or IRA money that we convert to Roth. So the Roth account for most people is the biggest tax saving strategy in their lifetimes that is left. And it needs to be used correctly. So for example, we're a math-based firm and we know to the penny how much money should be converted from IRA to Roth. If you have a pie chart, you're guessing. You have no idea. If you have a distribution plan, which we use at Decker Retirement Planning, we know to the penny how much should be converted from IRA to Roth. So what we do each year is we look at the client's gross income, which our plan shows. It includes Social Security, pension, rental real estate, portfolio income. We gross it up. So that's part of a distribution plan, is showing all their sources of income. And then it allows us to take away use their standard deduction or itemization to come up with an AGI, adjusted gross income. Then we look at the tax tables and see how much room is there between where they are and their next tax bracket. That's what we call headroom. Now, we want to keep clients from going from 12% to 22. We want to keep clients from 24 to 32, ideally. Those are big bracket jumps. The difference between 22 and 24, not so much. But we want to minimize the tax bracket, get as much Roth conversion as possible, and keep them in the same tax bracket. So that's what we do each year. We do tax planning that way, and we convert IRA to Roth. Now, there's 36 trillion reasons why most people expect that tax rates are going to go higher. So how smart are we to proactively pay taxes now and have that money grow tax-free? So that's what we do on the risk bucket. Now, to convert a client from taking the pieces of their portfolio, there's typically 3 different parts to the portfolio. There's cash, safe money, and risk. We put the Roth money and the IRA that we're converting to Roth into the risk bucket. Now, the cash portion of their portfolio, which is bucket 1 and their emergency cash, obviously that's cash management. That's a combination of money market. We buy short-term CDs. We get 4.5% to 5% on that money right now, but we work that money. Then when it comes to buckets 2, 3, 4, and 5, those are 3-year, 5-year, 7 and 10-year principal guaranteed accounts. We sprinkle some qualified and non-qualified money through those buckets. Qualified money are IRAs, money that you haven't paid tax on yet. Why do we want to proactively pay taxes now? Well, there's 2 reasons. One is we want to minimize clients' required minimum distribution exposure. By the time they turn 74, we want to make sure that we've spent down as much as we can on their IRA. Why? Because we don't want required minimum distributions to be a big part of their lives in retirement. Also, we think that tax rates are going up, so we proactively pay taxes on that money now. Second, we sprinkle non-qualified money through those buckets. Non-qualified money, Mark, when you pull up to the bank and you take $1,000 out of checking or savings, you're not taxed on that money. That's already taxed money. That's called non-qualified money. So we sprinkle that through buckets 2, 3, 4, and 5. So yeah, you might be getting $150,000 from your portfolio, but the taxable amount is much less than that. So that's how we do tax planning. That's called placement, where we take each part of the portfolio and we sprinkle it through the portfolio. So when we get a client and we convert their portfolio, their pie chart portfolio, that's how we do and move the pieces to where they should be. That's the tax planning that placement allows us to do. And Mark, there's not just the Roth conversion that is the tax planning that we do. We work with client CPAs. We're not a CPA, can't give tax advice, but we do promote tax strategies. And I'm going to just run through a bunch of them that we work with clients. Let's say that we've got a client that exercises stock options that spikes their taxable income in a year. Well, we use a donor advised fund. And if they're charitably inclined and they give to their charity or their churches, we're able to take 5 years of charitable donations and bring it into 1 year as an offset to lower the taxes in that year. If a client has large capital gains and they're in their 60s or younger, we're able to use a charitable remainder unit trust to zero out the capital gain by transferring that to their favorite charity, charities, church, whatever, and sell the building, could be real estate, could be stock, in the name of the charity or the church. There's no capital gain. And then the rules of the CRUT, the Charitable Remainder Unit Trust, is that a minimum they have to take 5% of income each year from the CRUT. And the agreement is that at least 20% is left over for the charities. So what we do is when we transfer those funds over, we get a very, very large charitable deduction that we use to either offset income in the future, or we use to move a massive amount of IRA to Roth. But then we have a taxable income stream that comes back to our clients. And if this is done correctly, it's in the name of two people, husband and wife, and it spreads the income out over their lifetime. So if we put X outside of their estate, we're able to bring in 4 or 5X back into their estate, and they've paid no capital gains. So that's something that allows clients to avoid that capital gains. The third tax strategy that we use, if we see an age difference and a client has married a spouse that's 10 years younger and they have a 401k, we use the quadro, qualified domestic relations order. There's an unhappy quadro, Mark, where a judge divides your assets in a divorce. That's an unhappy quadro. There's a happy quadro where we can use the qualified domestic relations order to split that 401k and send half to the younger spouse and keep half. So that allows a longer runway to do Roth conversions. Another strategy, we have a lot of clients with exposure to state or federal estate taxes. Now, half our clients say, what do I care? I'm dead. Whatever Johnny gets is more than I ever got. And so I'm not going to worry about the state or federal estate taxes. The other half of our clients say, oh, no. After paying a lifetime of taxes, I would roll over in my grave if I knew the state or the feds took another $1.5 million just because I died. I'll make sure that doesn't happen. So they buy a second to die life insurance trust held outside of their estate. That's key. And those funds, you're able to pay about 20 cents on the dollar and have those funds settle up for your estimated estate taxes when you die. There's other strategies, Mark, that we don't have time to get into. I'll just hit one other one. For people that own rental real estate, there's a way to use accelerated depreciation called cost segregation, where instead of 23, 27 years in depreciation, you use 10. Now your income stream is 100% tax-free. Every 10 years, you do a 1031 exchange, but that's a way for you to have rental real estate income stream be 100% tax-free.
So here's the deal. Brian covers a lot of ground every week on this program. Glad you were with us today. We'll do it again next week at the same time, same bat channel, all of that. But there's a lot going on. So the question is, do you know how your portfolio is doing? Do you know if it's set up the right way for what's ahead? Do you know if you're going to be good when it comes to retirement, that you don't have to worry about things? You're going to be able to do the things you've always dreamed of doing in retirement? Or are you one of those you're not really sure? I think we're going to be okay, but I don't know. Why wouldn't you find out? 833-707-3030 is the number to talk with Brian and the team at Decker Retirement Planning. 833-707-3030. Might be the most important phone call you make, and there's no cost. 833-707-3030. Brian, as always, enjoyed it. Enjoy the rest of the weekend. We'll do it again next week.
Thanks, Mark.
security, and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.